And so now we get to the part where we can put it all together into a simple system for managing risk and growing your account. In the last several sessions, you've learned quite a few different principles, and you've been giving a lot of information and several tools for how to do all this. But in your mind, it might seem like a very complex process and that there's lots to remember. And so using a system can really simplify things, can make it clear in your mind, and most important of all, can make it easy for you to apply and implement consistently. And that's what it's really all about, or else all this that we've been teaching is useless. And so, what have we learned so far about risk management? Well, we've learned that good risk management is a combination of correct position sizing and correct trade management. All right? Now, for the position sizing part, you need to what? Take small percentage risk, right? That's how you satisfy the position sizing part per trade. And for the trade management side, you need to enforce this small risk through the use of stop losses. All right? You need to be disciplined about your stop losses. And we've already talked a lot about this, discussed it in great detail how to go about all this, right? So this is just a small recap. Now, if you want to take all of that and just put it into a system that's easy to understand, easy to track in your own trading, and just makes sense to your mind, here's how you can do that. So, to systemize and simplify the whole process of risk management, you can use the concept of R multiples. Now, what are R multiples? How do we use them? And what is their benefit? Well, let's discuss that. In any trade you take, you have an initial risk. And let's call this initial risk R. So, if you were trading the S&P 500 futures, for instance, and you had a 2-point stop, that would be R. If it was a 4-point stop, that would be R. Now, the key thing here is that regardless of the size of the stop, if you're using the percent risk model, R is always actually equal, right? So if initial risk is R, what is an R multiple? Well, an R multiple is either a positive or negative multiple of R. And what does this mean? Well, here I'll give you an example. So assume you just took a trade and you have a 2-point stop, all right? And assume this trade makes money and you make 4 points on the trade. What was the R multiple of that trade? Well, if it was a 2-point stop and you made 4 points, the R multiple is obviously 4 divided by 2, it's 2 to 1. So the R multiple is 2, right? The reward to risk of the trade was 2 to 1, so the R multiple was 2. Now, if you have a trade, a 3-point stop loss, and you take the trade and the stop loss is hit, i.e. you lost 3 points, what is the R multiple there? Well, the R multiple will be -1, right? -3 divided by 3. You had a 3-point stop and you lost 3 points, so the R multiple there was -1. Do you get what we're doing? If you had a 2-point stop and you got a 10-point trade, your R multiple will be 5R, which means that you made 5 times as much on the trade as you risked. And -1R means you lost what you risked. So that's simply what an R multiple is. Now, what's good about using R multiples? Well, R multiples equalize all trades. And when we have the concept of R, we can compare any two strategies, any two traders, anything, right? Any two trades that we take, different markets, different instruments, different time frames, different stop levels, we can all equate it down back to R. And as long as we're using the percent risk model of position sizing, R will be equal across all those trades. Now, what about expectancy? Well, the cool thing about using R is that it makes expectancy very easy to calculate. instead of having to plug in numbers into that complex looking formula, what do you have to do? Well, all you have to do is add up the total R that you've generated and divide by the number of trades you've taken. And let me give you an example of how this actually works in the real world. So let's assume you've taken 10 trades. And here are the trade results. Okay. Your first trade was a 1R trade. Again, which means that let's say you had a 2-point stop and you got 2 points as a winner. So you got a 1R trade. Your next one was a 3.3R trade. Let's assume it doesn't matter. It doesn't have to be a 2-point stop. It could have been a 3-point stop, right? But you need 9.9 points after commissions. So 10 points minus a bit after the commissions. And you got to include the commissions in these for them to be totally accurate. And to include the commissions, obviously, you would just equate what the commission is as a factor of the tick value of the instrument you're trading. So I'll give you an example for the S&P 500, right? Let's assume you're trading and you get a commission of $5 a round turn. And we know that the S&P trades at $50 a point, right? So if your commission's $5 and the S&P trades at $50 a point, that means your commission is equal to basically 0.1 points. So if you had a 2-point stop, your real R would not be 2 points, it would be 2.1 points, which would include the commissions. So for you to actually get plus 1R, right, you would technically have to make more than 2 points. You would have to make in the S&P 2.25 points, 2.25, right, minus the commission on the exit of again 0.1. So your winner would be 2.15 after commissions divided by the 2.1 original R, and that gives you around plus 1R. Okay, so you would just have to include your commission in the original stop loss and then subtract your commission from your profit. Or if you have a loser, obviously include the commission in the loser, which makes the loser bigger, and then calculate your R based on that. And so anyways, we're assuming these are after commissions, and we have plus 1R for the first trade, then 3.3, then you have a loser minus 1, another loser minus 1, and so on. So we have 10 trades. And so what's the expectancy of this? Well, it's actually very easy to figure out. What you would do for the expectancy is you just add up all these 10 numbers. You just go plus 1, plus 3.3, minus 1, minus 1, minus 1, and so on, right? Until you get what is the total R you've made across these 10 trades. In this instance, the total R is 3.7. After you add up all these numbers, you're left with 3.7 R. So what's the expectancy? Well, the expectancy would be you got 3.7 R and it took you 10 trades to make that. So what is your profit per trade? Well, you just divide it by 10 and you end up with an expectancy of 0.37. So see how easy it is to find out your expectancy once you look at everything in terms of R? Even if you've never used the concept of R before, you could go back right now to your trading, and as long as you've been keeping track of your results and keeping track of how large your initial stop was and how much your winner or loser was, then you could figure out your expectancy using R. You would just convert the results of each trade to an R multiple, right? Which you do by dividing the profit or loss by the original stop, account for commissions by adding them into the stop and subtracting them from the profit or loss, and then get the R multiple for each trade. Once you have the R multiple for each trade, you simply just add up all the R multiples and divide by the number of trades, and you have your expectancy. And if you don't have it for your old trades, you don't have all those stats, well, you can just keep them going forward from now on. So for each trade you take, you would just record what your initial stop was, right? We'll take an example, 2 points in the S&P, for instance. Just make a little formula in Excel or something to add the commissions into that, or just do it manually every time, right? So assuming again $5 per round turn commission, your stop would not be 2 points, it would be 2.1 points because 1 point in the SB is worth $50 and $5 commission is 0.1 of $50. So your real risk if you take this trade would be 2 points times $50 is 100, and then you would also pay $5 in commission, so you would really be losing $105 per contract. And 2.1 times 50 is $105, and so that would be your R. And then you would keep track of how much you made or lost, right? And let's assume in this case you made 5 points on the trade. You would go, okay, 5, now minus 0.1, because what you actually took home is the 5 points minus the commission, so it's actually a net of 4.9. And your R multiple for that trade would be 4.9 divided by 2.1, which would be 2.33 R. That's what you would record. You would record for that trade 2.33 R. It doesn't matter if that trade made you 5 points. 5 points in itself is not significant. For instance, if you had another trade where you made 4 points, that could have been a better trade than this one, because in that trade you might have only risked 1 point. And so that would be a 4R trade, or slightly below because of commissions, maybe about 3.9. So it would actually be superior to the 5-point trade, even though you only made 4 points, because you risk less to make it. Right? And so this forces you to think of reward to risk on every trade, instead of just looking at points, which is not really what matters. And it just systemizes and simplifies all of your trading. Right? Every trade you think of as risking R, 1R, every trade. And then you see how much did I make as a multiple of my risk. Now, why does this simplify things? Well, for one, it gives you a clear way to record your trades, regardless of the markets or the time frames. You can equalize all your trades and just see which ones are performing better, which setups are performing better, all on an equal basis. Okay? They all become in terms of R. It makes it very easy to calculate expectancy. You just add up all your R, you see if it's positive or negative, divide by the number of trades, and you have your expectancy instantly. And most importantly, it makes you focus on correct position sizing and correct trade management, because your focus is R. To even use the concept of R, you have to have a stop loss. That is what makes it 1R risk, wherever your stop loss is. That's your 1R. Alright, so you have to have one. And you have to be using the percent risk model to be sizing that R. Let's say your R is 2% risk. That'll tell you how many contracts to trade. Okay. And then most importantly, it'll keep you focused on sticking to your stop losses, because your goal will be to keep all stops maximum of minus 1R. If you look at these trade results, right, there were some bigger winners, 3.3R, 2R, 1.5R, but all the losers were minus 1 or less, minus 0.6. In that case, you would have exited before it hit your stop, which is fine. But all losers here are minus 1R, and there's a reason for that, because you always take your loss at your stop point. And so your mind becomes focused on making sure you never have more than a minus 1R loser. Maybe you'll have slippage once in a while, and when it hits your stop, you won't get out exactly at the point you want it to. Maybe it'll be minus 1.1 or minus 1.2. That's okay. But your goal, your whole focus is never have a loser that's bigger than minus 1R. You don't want minus 2R, minus 3R, or worse losers. Now, if I just told you, cut your losses quickly, that's fine, and you might listen, and hopefully you would. But if I told you never have a loser that's greater than minus 1R, it's more concrete. You're thinking in terms of R, you're watching your expectancy go forward, and you don't want to screw it up. You want to keep trying to improve your expectancy, improve your edge. And the worst way to screw it up, and you'll start seeing it if you try it and you do screw it up, is try having a minus 2 or minus 3R loser. That's just going to kill your expectancy instantly. It'll be like having 3 losers in one when you're at a minus 3R. And God forbid having more, like minus 5R or minus 10R, like some traders would. And so you keep focused on only having minus 1R losers. and hopefully bigger winners. Right? Now you could focus on accuracy if you want. If you develop a strategy, it'll all depend on your style. If you develop a high accuracy strategy that tries to go for 1R winners and has 1R losers but wins 70% of the time, yeah, you'll still come out ahead in terms of total R. This particular strategy here, if, as you see, half of them are winners, half of them are losers. So right now it's 50-50 with these 10 results. But the winners are bigger than the losers on average. And that's what we recommend. We don't recommend trying to go for the accuracy. Accuracy isn't bad, and if you can get it, that's great. But always try to go for the larger R multiples. Always try to get profits that are multiple R. 2R, 3R, the more the better. Because those will rack up quickly and improve your expectancy. And so just doing all this just systemizes things. Simplifies them in your mind. Every trade you take is an R. You want to keep all your losses to -1R. You want to try to get multiple R on your winners. You add them all up, divide by the number of trades, you have your expectancy. The more trades you have, the higher the frequency. You choose consistent percent risk for each R, and you have a complete risk management system right there. It's easy to understand. It's consistent. It forces you to keep track of things. It forces you to focus on the right things. And that's how you'll survive. Alright, so I hope this makes sense. And I really advise you to use it in your own trading. Start thinking in terms of reward to risk, in terms of R multiples. Start recording all your trades based on that. Use the percent risk model to determine the position size you'll use for each R. Focus on never having more than a -1R loser, and then just build your strategy. You'll have taken care of all the things that screw traders up. You'll be focused on the right areas, and you'll be giving yourself the best chance possible to succeed. Over and over and over in the last several sessions in this module, all I've been harping on again and again is the importance of discipline in this area. And I've given you models and systems to simplify it so you just follow them. No gray areas, black and white, rigid following of them. And usually we don't like rules and we don't like following things, but trust me, I'm telling you, I follow them in my own trading. This is what works. Leave the analysis and the flexibility and the discretion to your market reading, to your strategy, to your execution. But when it comes to risk management in the form of position sizing and trade management, stick to the system. It'll really, really pay off for you in the long run.